Nobody warned them in 1999 either. The market was up. Earnings looked strong. People were getting rich and feeling smart. And then a single number, one that had been flashing red for months, finally collected what it was owed. The same number is sitting at almost the exact same level right now, and this time there is one group of investors who are not just protected. They are being paid while everyone else figures it out. I want to show you what that number is, what it has meant every single time in history, and exactly how dividend investors are positioned to win either way. It is called the Shiller CAPE ratio. Nobel Prize-winning economist Robert Shiller built it to answer one simple question. Are stocks actually expensive, or do they just look expensive? Here's how it works. Instead of measuring price against 1 year of earnings, which can be distorted by a boom or a recession, the CAPE ratio uses 10 full years of inflation-adjusted earnings. That gives you a much cleaner, much more honest picture of what you're actually paying for. The long-run average since 1881 is roughly 17. Right now it sits at approximately 40 to 42, more than double the historical norm. To put that in perspective, the only other time in over 140 years this ratio climbed above 40 was December 1999, at the absolute peak of the dot-com bubble. Within 2.5 years, the S&P 500 lost nearly half its value. Now, here's the part people always get wrong about this number. It is not a crash timer. It does not tell you the market falls next Tuesday. What it tells you, consistently across 140 years of data, is that when you buy stocks at these prices, your returns over the next decade will likely disappoint. And when the correction arrives, it tends to be deep. The market can stay expensive longer than logic says it should, but it has never stayed expensive forever. Here's what makes 2026 more complicated than a simple valuation warning. The market is up, earnings are strong. Over 84% of S&P 500 companies that have reported results this year beat expectations, the highest rate since 2021. On the surface, everything looks fine. But underneath the surface, several things are happening at once. The United States is now being downgraded by all three major credit rating agencies. Moody's has the last holdout. They cut the U.S. rating in May 2025, citing $36 trillion in national debt and interest payments that already consume 18 cents of every dollar the government brings in. By 2035, that number is projected to hit 30 cents on the dollar before a single road is repaired, a single school is funded, or a single benefit is paid. Tariffs introduced over the last year are still working their way through the economy. Manufacturing activity contracted for 9 straight months in 2025. Consumer confidence is shaky. The Federal Reserve is walking a tightrope between inflation that will not fully go away and an economy that is slowing. None of this means the market crashes tomorrow. Goldman Sachs still has a bullish base case for the S&P 500 this year. But it does mean the era of easy, broad market returns, where almost any index fund made you look like a genius, may be giving way to something that rewards better strategy. And that's exactly where dividend investors have an edge. When the market gets nervous, investors rotate. They move away from high-priced growth stocks toward companies with real earnings, real cash flow, and real income. That rotation is already happening. SCHD, the Schwab U.S. Dividend Equity ETF, is up over double what the S&P 500 has returned so far this year, more than doubling the S&P 500's return over the same period. This is not a coincidence. It is the market telling you exactly what it values when uncertainty rises: quality, profitability, and income. SCHD earns that rotation because of how it is built. Every company in the fund must have raised its dividend for at least 10 consecutive years and passed strict screens for cash flow, return on equity, and balance sheet strength. That means no speculative bets, no story stocks, just businesses that have proven through multiple recessions and market cycles that they generate real money and share it with investors. The results speak for themselves. Since launch in October 2011, SCHD has delivered an average annual return of over 13%, growing a $10,000 investment to more than $59,000 with dividends reinvested. Its current yield of around 3.3% is nearly triple what the S&P 500 pays. But the number that should stop you in your tracks is this one. Investors who bought SCHD in 2011, when the yield was just 2.6%, are now collecting 12.5% on their original investment. Not because anything magical happened, because dividend growth compounded quietly for 15 years while they did nothing but hold. That is the machine, and the only way to access it is to start it. So what do you actually do right now? You do not try to time the top. Nobody has ever done that consistently. The investors who waited for certainty before buying in 2009 missed a 68% gain in the first 12 months of the recovery because the market moved before the news turned good, and it has always worked that way. You invest consistently using dollar cost averaging. Pick a fixed amount, invest it on a fixed schedule. Monthly works best. When the prices dip, your same dollar buys more shares. When prices rise, you participated. You remove emotion entirely, and you let the math do its job. You turn on dividend reinvestment. Every quarterly payment goes back into buying more shares. Those shares generate their own dividends next quarter. That cycle, compounding on top of compounding, is what turns a 2.6% starting yield into 12.5% over time. It is invisible in year 1. It is life-changing by year 15. And you think in decades, not days. The S&P 500 has never produced a negative return over any 20-year rolling period in its entire history. Through the Great Depression, through the 1970s, through 2008, time in the market is not a cliche. It is the only thing that has ever reliably worked for ordinary people building real wealth. Here is what I want you to take away from this video. The CAPE ratio is not saying the market collapses next month. It's saying that patience and income matter more right now than chasing price. It is saying the next decade will likely reward the investor who is collecting dividends and compounding quietly, more than the investor betting on another decade of tech-driven index returns. The investors who will look back on 2026 and say they got it right are not the ones who predicted anything. They are the ones who owned quality, reinvested consistently, and let the machine run. That is the SCHD approach. That is what this channel is built on, and it works whether the market goes up, goes sideways, or corrects from here. If this hit different for you today, subscribe and go watch our SCHD compounding video next, because understanding the warning is step 1. Building the machine is step 2. I'm not a financial advisor, this is education, but it is the kind that changes where you end up. SCHD content is for education only, not financial advice. Always do your own research.